Have you ever felt like your money disappears faster than you can invest it? Or maybe you've been investing here and there, but there's no real structure or strategy behind it? If that sounds like you, you're not alone. A lot of people struggle with figuring out how much to save, how much to invest, and where to actually put their money. That's where the 50-30-20 investment strategy comes in. Now, if you've heard of budgeting rules like 50-30-20, where 50% goes to needs, 30% to wants, and 20% to savings, this is not that. This is a full-on investment strategy, something you can use to shape how you build long-term wealth, how you allocate your investments, and how you plan your financial future. Let's break it down in simple terms and talk about how you can apply it to your life. Whether you're just starting out or looking to bring some order to your financial chaos. So what is the 50-30-20 investment strategy? It's a way to divide your investable money across 3 core categories. Here's the basic breakdown. 50% goes into safe, income-generating assets. 30% goes into growth assets. 20% goes into high-risk, high-reward opportunities. Let's start with the first chunk. 50% into safe, income-generating assets. This is your financial safety net. These are the investments that might not make you rich overnight, but they provide consistent income and protect your capital. We're talking about things like bonds and bond ETFs, high-interest savings accounts, GICs, guaranteed investment certificates, dividend-paying blue-chip stocks, real estate investment trusts, REITs, that pay reliable distributions. The point of this 50% is stability. It's not here to double your money in a year. It's here to make sure you're not starting from zero if the market crashes or if your riskier bets don't pan out. Let's say you have $10,000 to invest. According to this model, $5,000 would go toward these safer, income-producing assets. Maybe you put $2,000 into a bond ETF like BND or XBB, $2,000 into a dividend-focused ETF like VDY, and $1,000 into a high-interest savings account. These are the types of assets that allow you to sleep at night. They keep your portfolio from swinging too wildly, and over time, they can still grow thanks to interest and reinvested dividends. Now, let's move on to the 30% growth assets. This is where you start building real wealth over time. These are the assets that grow faster than inflation and help increase your net worth. We're talking about broad market index funds and ETFs like the S&P 500, individual stocks in strong companies with long-term upside, real estate properties in growth markets, mutual funds with a growth mandate. These investments might be a bit more volatile than the first category, but over the long haul, they tend to outperform. If we go back to our $10,000 example, $3,000 would go into growth investments. Maybe you buy $1,500 of an S&P 500 wide ETF like VO or VFV, $1,000 in a tech stock like Apple or Microsoft, and $500 in a real estate crowdfunding platform targeting long-term appreciation. The goal here isn't to flip or chase hype. It's to find solid investments with strong fundamentals, ideally things you can hold for years or decades. And finally, the 20%, your high-risk, high-reward bucket. This is where you get aggressive. These are the types of investments that could explode in value or completely tank. And that's okay, because this is the money you've already mentally prepared to lose if things go south. This could include crypto, startups, or private equity, small cap stocks, leveraged ETFs, speculative tech plays, emerging market opportunities. Now obviously, this isn't for everyone, but if you're young, have time on your side, or simply have a higher risk tolerance, this 20% can be a game changer. In our example, $2,000 would go into these speculative plays. Maybe you put $1,000 into Bitcoin or Ethereum, $500 into a startup on a platform like AngelList, and $500 into a biotech stock that's working on breakthrough tech. You're not betting the farm here. You're placing smart, calculated risks using a portion of your money that won't ruin your life if it doesn't pan out. Now, here's where things get interesting. Why does this strategy work so well? Because it's balanced. You're protecting your downside with stable assets, you're building long-term wealth through growth, and you're giving yourself a shot at outsized returns through riskier bets. It also forces you to think about your money in categories, not just one big pot. That means every dollar has a job. And that's the foundation of good investing. So how do you actually follow this principle in real life? Start by figuring out your total investable amount. That could be your savings, a lump sum from a bonus, or your monthly contributions. Let's say you invest $1,000 a month. You'd allocate $500 to safe income producing assets, $300 to growth-focused investments, $200 to high-risk, high-reward opportunities. If you're not sure where to start, use ETFs to simplify the process. For safety, look into bond ETFs or dividend ETFs. For growth, go with broad market index funds. For the riskier part, start with a small amount in crypto or a speculative ETF and learn as you go. You don't have to nail every investment. The structure of the 50-30-20 plan is what keeps you balanced. Even if your riskier bets flop, you've still got 80% of your money working in more reliable areas. Now let's talk about how this can impact your long-term financial plan. First, it brings discipline. You won't be randomly dumping money into meme stocks or crypto just because you saw a post on social media. Every dollar has a category, and that helps protect you from emotional investing. Second, it builds resilience. When markets crash or get volatile, your income-producing assets keep you grounded. You'll still have cash flow coming in through dividends, interest, and income distributions. Third, it gives you upside. That 20% might not pay off every year, but one big winner in a high-risk category can have a huge impact on your net worth. Think about people who bought Amazon in 2001 or Bitcoin in 2015. Fourth, it adapts to your age and goals. When you're younger, you might want to shift more into growth and risk. As you get older and closer to retirement, you can gradually move more into the income-producing side to protect your capital. This strategy is flexible. It's not a rigid formula. It's a framework, a mindset, and that's what makes it powerful. Now, some recommendations if you want to try this. First, automate your investing. Use pre-authorized contributions or robo-advisors to handle the allocations automatically. If you're putting in $1,000 a month, split it into $500, $300, and $200 across 3 separate accounts or ETFs. Second, rebalance every 6 months or once a year. Let's say your riskier investments go on a crazy run and now make up 35% of your portfolio. That's great, but you want to stick to your plan. Rebalance back to the original 50-30-20 split. This keeps your risk in check. Third, track everything. Use a simple spreadsheet or an app like Personal Capital or Wealthica. Make sure you know where your money is and how each category is performing. Fourth, educate yourself. Especially in the high-risk area, know what you're getting into. Read company reports, understand crypto projects, learn about the risks. Don't invest in what you don't understand. And finally, be patient. The 50-30-20 strategy isn't about getting rich overnight. It's about building wealth systematically while protecting your downside and giving yourself the chance to win big when opportunities show up. Imagine 10 years from now, you've been following this strategy the whole time. Your income-producing assets are generating thousands in passive income. Your growth assets have doubled or tripled, and maybe 1 or 2 of those high-risk plays paid off big. That's the power of a plan. Most people don't build wealth because they don't have a system. They either play it too safe and never grow, or they swing for the fences and wipe out. The 50-30-20 strategy gives you the best of both worlds: security, growth, and the chance for explosive upside. So if you're tired of guessing, or if you just want a smarter way to manage your investments, give this a try. Start small, stay consistent, stick to the percentages, and let time do the heavy lifting. Let me know in the comments how you'd allocate your portfolio using the 50-30-20 strategy, and if you'd tweak the numbers based on your own goals or risk tolerance. Thanks for watching, and I'll see you in the next one.